Turkey has been home to one of the most turbulent major economies in the world over the last 2 decades. When we last explored the country, we found an economy with incredibly strong fundamentals that were being completely undermined by some unusual macroeconomic decisions. Inflation has been the headline issue in the country for the past 5 years, with the Turkish lira having lost 96% of its value against the world reserve since the currency was first introduced in 2005. This is especially concerning considering that the reason the country introduced a new currency in 2005 was to replace the old Turkish lira, a currency that itself failed due to hyperinflation. So it's easy to see why economists and regular participants in the economy are starting to see this as a bit of a systemic issue. The current value loss of 96% is also compared to the US dollar, which itself has lost about 40% of its purchasing power over the same time period. So yeah, inflation in Turkey has been severe and consistent. But on a brighter note, there is news that could indicate that things are starting to turn around. The country was stubbornly keeping interest rates low, which was only further accelerating inflation, but in the last few months they've finally started raising rates, which should, in theory, stabilise the value of the currency and by extension the rest of the economy. The problem is, it doesn't look like it's working, at least not yet. This might just be the case of too little too late, but really the biggest challenge with the currency now is getting people to use it instead of just doing business in other more reliable foreign currencies. After 2 decades and 2 failed currencies, it's hard to convince a highly intelligent population that this time will be different. The tragedy of this all is that outside of these wacky numbers, Turkey is a highly promising economy. It has a huge and talented workforce, a wealth of natural resources and natural beauty, and above all else, it's a masterful and essential global bridge between economic factions that are drifting further apart. The art of good business is being a good middleman, and Turkey could play a very valuable role in the new global economy if only it got its own situation under control. So, how has the economy of Turkey been going since we last explored it? Why has it been unable to control inflation? And finally, what realistic solutions does it have left to stabilise its economy? When researching videos like this here, I'm spending hours on the internet and sometimes I have to log into specific industry websites to access market reports. As a consequence, I'm getting lots of spam emails, and that's because companies can go to data brokers and buy information about you that has been leaked or scraped from unprotected servers for pennies to use not only for scams but for identity theft and even loan fraud. That's where our sponsor Delete Me comes in. Our channel manager, ever the willing guinea pig, put in a few of the main emails and phone numbers he used, and within a few days they sent his report showing that 5 data brokers had his data. As someone who's always careful with passwords and not clicking on his scammy links, he was a bit surprised that brokers even had the details of his family and the value of his home. Delete Me already removed our channel manager's data from all of the brokers and scanned 792 listings to make sure he wasn't on any others as well. And all of these data broker websites are continuously scanned, so if any of your info does pop up on them, it's delisted as quickly as possible without you having to lift a finger. So go to joindeleteme.com/EE20 by scanning the QR code or clicking the link in the description and get 20% off eligible Delete Me plans and keep your data out of the hands of shady brokers for good. So a quick refresher to Turkey's situation is probably overdue. In the mid to late 2000s, Turkey was one of the fastest growing economies in the world thanks to a variety of factors. The country up until that point had consistent issues with inflation, but new laws gave more power to the central bank to take an active hand in price stability, and a new currency was finally starting to control inflation. The idea of a central bank that is independent to set its own monetary policy is that if inflation gets too high, it can raise interest rates, which makes it simultaneously more expensive to borrow money and more lucrative to save it. This, all other things being equal, should reduce the amount of money in active circulation, which should encourage businesses to lower prices to fight for the fewer dollars or lira that are in circulation. Higher interest rates are very politically unpopular though because they do inflict a lot of financial pain. They make debts more expensive and they slow down businesses, which usually leads to unemployment, so the independence of a central bank gives them the ability to make these unpopular but often essential decisions. Giving its central bank independence signalled to the Turkish economy that it was taking price stability seriously, which not only gave a level of confidence to the local population, but also to potential international investors. Replacing the old currency at a rate of 1 million to 1 also helped bring the Turkish lira back in line with other global currencies. If €1 billion investment exchanges to a quadrillion Turkish lira, it just makes things difficult to deal with and also inherently destroys a bit of trust in the economy's financial system. So even though replacing the currency might not do anything in real terms, it did do a lot to instill a sense of confidence in the new system. Now, for a while, this worked. Between 2001 and 2013, the country's economic output more than quadrupled, and it made big investments into industry, education, and international trade. Turkey sits geographically as a bridge between the consumer markets and advanced industries of Europe and the natural resource wealth of the Middle East and Russia. Even back then, Turkey was accommodating energy infrastructure and playing the role of a mediator between these two markets, which was a win-win for both sides, but an even bigger win for Turkey, who made reliable and sustainable revenues by accommodating this trade. During this time, the country shifted away from agriculture and into industries like medium to high-end manufacturing, construction, and finance. Finance, especially under the old Turkish financial system, would have been next to impossible, but for a while this industry thrived, especially loaning money to households to take advantage of this meteoric economic rise the country was experiencing. The government itself was able to oversee this growth without taking on too much debt itself, which meant in theory it could step in and help out the economy if it ever needed a bit of a boost with the old money printer. But of course, this didn't last forever. Turkey's annual output peaked in 2013 before starting a slow decline for the rest of the decade, and it has to date not achieved that same level of output since. The problem was that the new independent central bank had a very difficult trade-off to make. After being given independence in 2001, they hiked up interest rates to stabilise inflation, but they slowly lowered them over time to encourage local business activity. Even over the time of rapid economic growth in the country, the value of the currency continued to decline, but the central bank didn't want to raise rates because it could stifle that growth. A devalued currency often isn't the worst thing in a growing economy anyway, because it makes exports more competitive and imports more expensive, encouraging people to consume domestically. But if the slide of the Turkish lira became too extreme to the point where it outpaced the overall growth of the economy, then the country would find itself back in the same position it was during the hyperinflation crisis of 2001. At the same time though, interest rates in Europe and the USA were at all-time lows to combat the sluggish economic recovery from the GFC. So what a lot of Turkish investors did was go and borrow money in these currencies at rates approaching 0%, and then use that to speculate in Turkey with its record levels of growth. This created a situation where a majority of the country's private sector debt was denominated in foreign currencies, and that eventually needs to be paid back, which usually meant exchanging Turkish lira, pushing down its value. There wasn't much international demand for the currency either, because Turkey was still a net importer of goods, and even though its interest rates were much higher than the West, after the devaluation of the currency they were lower, so by keeping money in lira, people were losing money compared to their home currency. If foreign investors wanted exposure to the Turkish market, normally that would be a problem that they would have to accept and factor into their calculations. If an Australian wants to buy a house in the USA, they would need to trade their Australian dollars for US dollars to buy that house, which should, all other things being equal, push down the price of the Australian dollar and push up the price of the US dollar. In doing this, Australian investors also accept a level of exchange rate risk. If their property doubles in price but the US dollar halves in value compared to the Australian dollar, then the Australian investor is really no better off overall. Of course, in reality, one person isn't going to be able to move enough currency for this to make a tangible impact on the exchange rate, but if enough investors only start flowing money one way, then it will move the price. Now, in Turkey during this time, foreign investors didn't have this problem. They could just use their own currency to avoid the foreign exchange risk, since so much of the country was taking out loans in foreign currencies anyway. This meant that there were very few people buying lira, but a lot of people selling it to pay for imports or to cover repayments on foreign loans. The central bank was also unable to raise rates too quickly to compensate for this, because that would just encourage more foreign borrowing if domestic loans became any more expensive than they already were. To make matters worse, most of this investment was going towards unproductive assets like real estate, rather than building out industries that could generate cash flows to service these payments, like factories, ports, training, or other infrastructure. It was also a situation that strongly encouraged wild speculation, which did pour fuel onto the fire of economic growth until it all came crashing down. The catalyst for the slowdown is hard to pinpoint, but it certainly wasn't helped by an attempted coup in 2016. Following this display of political instability and the retaliations that were made by the government in response to it, the level of foreign investment into Turkey slowed dramatically because people weren't as sure about its future. A year later, in a referendum motivated by the coup attempt, the country changed its constitution to give far more power to its head of state, which indirectly meant that the new president could wield much more control over things like interest rates. That's where the devaluation of the lira went from a slow issue primarily impacting industries operating internationally to an all-out crisis of extremely high inflation. Now, that crisis has been well covered, and we even made an entire video on it 2 years ago as it was fully unfolding, so as always we don't want to repeat too much here. In brief, ideological motivations caused the government to put pressure on the central bank to keep rates low. They did this by firing any central bank chiefs that raised rates, leading to spiralling inflation that hit as high as 80% on an annualised rate. At that extreme level, it was having very tangible impacts on working class people in the country that didn't have the resources to move their wealth into foreign currencies. The argument was that a currency worth less would make Turkey a more competitive exporter because the price of their goods would be artificially deflated. Now, this wasn't totally unfounded. Some countries, China in particular, have controlled the value of their currency to make their goods and services more competitive in countries with more valuable currencies, which contributed to their export dominance over the past 3 decades. But the Turkish plan missed a lot of nuance. Just having a currency with a face value lower than another currency doesn't automatically make their goods cheaper. Japan isn't 160 times more competitive than the USA because its currency has a face value 160 times less. It's really about purchasing power. If $10 could buy one hammer in the USA, and the equivalent of roughly 1600 yen could also buy one hammer in Japan, then there is no inherent benefit of importing that hammer from Japan. But if the Japanese government intentionally let their foreign exchange value slip by lowering their interest rates or by selling a lot of their currency in foreign exchange markets, then that $10 might be able to buy 3200 yen, which would be able to buy 2 hammers in Japan, making it worthwhile to import those hammers. Now, eventually as importers convert their dollars into yen to buy Japanese hammers, that will push the value of the currency back up, and eventually Japanese businesses will realise that they can charge more for their hammers, but that can take a very long time, and in the interim, Japan has benefited from a huge boost to its domestic hammer manufacturing industry. Now, this is of course an extremely oversimplified example, but the problem for Turkey is that it isn't a major export economy. It actually has a pretty large trade deficit, so all this really does is make its imports more expensive, stifling domestic industries. Turkey would be able to add much more value by acting as an importer-exporter given its fantastic geographic position and its ties east and west. But a currency that nobody wants to deal with makes that role very challenging to fill. Turkey also attempted to restrict the use of foreign currencies in the country in response to the problems that foreign borrowing caused. But again, that only really further hurts the real economy because it makes Turkey more difficult to deal with as a finance and trade partner. The other argument for keeping interest rates low was even more ideological. The president and his government have said that interest is usurious and immoral. That's an argument well outside our area of expertise, but it is denying the country a vital tool to address one of its most pressing problems. Either way, that was then and this is now. Gradually, the government has either willingly or unwillingly walked back a lot of these decisions, and the central bank is once again raising interest rates, which as of the time of making this video, now sit at over 50%. Unfortunately, it's not looking to be having much of an effect, as at the same time the country is printing record amounts of its currency and pushing it out as loans through its banks, mostly to businesses. The businesses are happy to take out these loans, even at extremely high interest rates, because inflation is still outpacing the interest on the loans, which means they're effectively getting a negative interest rate, or put another way, they are indirectly being paid to borrow money. Another mechanism that was supposed to alleviate inflation has actually caused it. The Turkish people had no incentive to save their money because it was losing value so fast. Instead, they tried to spend it as quickly as possible, which further increased inflation. To combat this, the government announced a special savings account that would be hedged against the falling value of the lira. Cash kept in the account would be awarded a special interest payment equal to the decline in the value of the currency on top of the regular interest payment, so that savers would be rewarded for keeping money in the bank instead of just spending it as soon as they got it. The problem this caused is that it acted as a feedback loop of money creation. If inflation in a year was 50%, these savings accounts would pay their account holders an extra 50% on their savings, which would just increase the money supply even further, pushing up prices, which required even bigger bonuses on these accounts. Unsurprisingly, the government quickly ended this scheme after the last election. So it seems that everything it does is just making it worse, which is why it's probably more productive to ask if there are any solutions left for Turkey. The country has been here before. This current economic timeline effectively started after the country last did a major reset from hyperinflation, but the solutions will not be as pleasant. And realistically, it will require a major political shift and a reset of the currency alongside the institutions that manage it. The financial games of moving bigger and bigger numbers around in accounts has very tangible impacts on the real economy. A currency is supposed to be a store of value and a medium of exchange, and if nobody inside or outside of the country trusts it to do that, then the economy is denied a very basic yet essential tool to operate. Running an economy without a reliable currency is like running an engine without oil. Eventually things seize up. This is a real shame because something that most outlets fail to mention, including ourselves when we last covered the country, is that outside of headline-grabbing monetary shenanigans, Turkey has a highly promising economy. Its population is large, well-educated and young. It's in a perfect position to capitalise on its labour force that is more cost-competitive than its European neighbours to the west, but more skilled than its resource-richer neighbours to the east. Turkey also has huge potential as a tourist hotspot. Even with all of the very public and very well-reported challenges the country has been dealing with over the last decade, it's still one of the most popular tourist destinations in the world, which has in the past been a vital source of foreign currency inflows as tourists bring along their own money to spend. The country is also extremely popular for medical tourism, a highly lucrative form of tourism since people spend a lot more on skilled services to get hair transplants than they do just getting a few cocktails at a hotel. If the country could display a level of stability and peace to the world, then there's no reason that this couldn't become a major growth industry in and of itself. The country could also keep on being a global middleman and start to benefit from the trend of friendshoring. Turkey is part of NATO, but it also maintains close relations with Russia. It's culturally close to many major powers in the Middle East, but it's also part of the EU customs union. As these groups pull further apart from one another, there is going to be a lot of money to be made on either side as the one person that is friends with everybody, or at least is willing to say the right things to keep the money flowing. Nobody can predict the future, least of all economists. But the OECD projects that Turkey will be the 5th largest economy in the world by purchasing power parity in 2060. That would also make it the largest economy within Europe and the largest economy within the Middle East. It's a huge economic machine that has been denied the lubricant it needs to run smoothly, a real shame given its real potential. Now, another country that has had a seemingly endless struggle with inflation is Argentina. We made a video on that country a few months ago, which we'll also be doing a follow-up on soon, but for now you should be able to click to that video on your screen now. Thanks for watching, mate. Bye.